Good evening and good morning to our listeners in Asia. My name is Greg Lim. I'm one of the research directors here at The Block, and I'm the host for tonight's webinar, which is Restoring Confidence and Building for the Future. If I could get a quick background from each of our guests here, and then we can get started.
I'll go first. My name is Patrick Hillman. I'm the Chief Strategy Officer at Binance. Prior to joining Binance about almost a year and a half ago, I was the head of global crisis management for Edelman. And then prior to that, I was at General Electric and at the National Association of Manufacturers.
I'll go next. Alessio here. I'm the CEO and co-founder of Hex Trust, a global digital asset custodian.
All right. Thank you, Alicia and Patrick. My name is Nanix, and I'm the managing director at OKX. Joined OKX from 5 years ago in day one. So previously HFT traders. Nice to meet you guys.
All right. This is Xiao, investment director from HashKey Capital, and I think everyone just keep it short. So maybe one sentence about HashKey Capital. So we are one of the biggest crypto VC in Asia, and started to invest in this sector since 2015. And our current AUM is something about 1 billion since the inception.
Awesome, thank you. So, kicking us off, recently we've seen a lot of championing of decentralization, DeFi, and a mistrust in centralized crypto entities and companies. From a high level, how do we reaffirm and rebuild trust in centralized digital asset firms?
Well, I guess I can kick us off here. I think it's fairly obvious that the marketplace is demanding more transparency in CEXs. I think we have to admit that probably this should have happened a long time ago. Crypto and Web3 itself was really built upon the idea that code is actually more powerful than law. Laws can be applied liberally or more conservatively, whereas code is code. And in the end, I think users are now demanding it in the marketplace that there have to be much more stringent protocols and transparency, not only into reserves, but also into liabilities. It's the reason why you've seen, obviously, Binance. We just published our first proof of reserves and liabilities, which was then verified by Mazars. It's just the first step for us. We're going to have to continue to roll out in the coming months more and more of the tokens on our platform until we have, not probably total because there's so many small coins, but probably our top 10, top 20 coins, which will probably cover, approximately 96, 97% of our total platform. And again, there's really no choice in this. The market is mandating it. Crypto is one of the last true free markets. And any organization that doesn't abide by this is probably going to fall by the wayside because users are going to vote with their feet.
Maybe let me build on that, Patrick. I think I completely agree with your point. Basically, I think if we want to really structure this problem, right, we need to look at two different models that exchanges can follow, right? So the first model is the fully centralized exchange, which is similar to what we basically the same model that the model that we see in traditional finance. And the other one is a slightly different model, which kind of integrates the advantages of transparency that the blockchain brings to us, right? So if we want to go for the first model, then I think it is necessary to apply the same kind of rules and guidelines that we have in traditional finance. So the segregation of assets from the exchanges and clients, I think is key. And at this stage in today's world, I really see very little value in exchanges acting as principal, holding clients' money, but they could just act as agents, basically not having to bear the responsibility of security of clients' money, etc. So this is the first model: follow traditional finance, segregate the assets, use independent or multiple independent custodians to hold clients' assets. The second one is more of all right, so we have this blockchain, it's beautiful, it's transparent. So how about we kind of merge the advantages of what DeFi has brought to us with centralized exchanges. And we start implementing models such as escrow smart contracts or decentralized clearing, where basically we exchanges and clients can basically interact, and exchanges become intermediaries while the assets are always in self-custody with the clients. I think we need to, for the future of blockchain to actually be successful, we need to start thinking about kind of really changing the current model and look at what we have on the table.
Yeah,
I don't want to hog here, but I'm going to respond because I think we actually agree with you. Obviously, Binance is the largest CEX globally, but we've diversified our business because CZ and our leadership team fully believe that decentralization in full is going to be the future of this industry, which is why we're working to diversify, making investments in things like PancakeSwap and all sorts of other truly decentralized protocols. I think you're right. There's probably going to be some sort of future state that has a hybrid, if you will. First of all, I think at some point, wallet technology is going to get a lot better, and more users are going to feel safer using a DEX because there will be just a simpler process for owning those funds, moving those funds, most importantly, and spending those funds. Right now, there's a pretty high bar to be able to get comfortable utilizing that ecosystem. That's going to change over time. I also think there's always going to be, to a certain extent, there's going to be an audience like myself, I'm over 40 now, who's always going to feel more comfortable in a CEX environment because that's just what they're used to, right? My dad still has an iPod. I don't understand why, but he has a flip phone. He likes an iPod. At some point, technology eclipsed him, and he prefers that sort of operating model. We think there's always going to be a group that's always going to prefer a true CEX, exchange. But I think to your point, there's going to be a hybrid model, and it's probably going to come a lot sooner than people think.
I think probably the best way to regain the confidence is probably having a unified experience, within a hybrid model. Central exchanges with decentralized components, or decentralized components with a centralized features, customer service, and KYC components. I think that is what the market is expecting, and what the market is mandating us for exchanges to move forward. Exchange having proof of reserve is like the baby steps, but this baby steps is already having better transparency than a lot of financial institutions already at this point of time. Moving forward, everyone will have their self-custody, full custody of assets, and they have a full transparency on how exchange governance and how exchange is going to operate.
Well, for me, I think the most important or urgent thing is that the centralized firms need to increase the information transparency. For example, we all saw that after the FTX bank run, a lot of centralized exchanges published their proof of Merkle tree. So this is a very good way to disclose your asset situation. And sometimes independent auditing is also necessary. And on the other hand, I also want to echo what Alessio and Patrick said. I think the platforms can try leverage the blockchain technology more. For example, they can involve smart contracts in the asset exchange process or maybe settlement process. It's just like setting up permissioned DEX where the listing evaluation process or assets selecting process is centralized, but the trading function is on the chain. And we've already seen such hybrid exchanges in Asia, even talking with regulators. I think this seems a very good way for all counterparty, including the users, regulators, or the exchange platforms.
Gotcha. So, thinking about that in terms of having that type of on-chain transparency, what's the role in relationship looking forward that custodians and centralized exchanges are going to have together? What does that environment look like moving forward?
I can go first because currently we are integrating in terms of transparency, we have 3 steps, right? The very first step is proof of reserve. The second step, we are going to integrate a lot of third-party custodian as an option to the clients to select their counterparty or their custodian to be integrated to be traded on OKX. The challenge is huge as well, because it's not exactly that putting money in custodian, then you can essentially be traced on OKX or any other central exchanges. One of the challenges mostly related to technical challenge. Technical challenge is the custodian, the third-party custodian need to understand the concept of off-exchange settlement. In order to understand off-exchange settlement, they need to maybe somehow understand the full picture of how exchange calculate unrealized P&L, realized P&L, mark price, price limits, a lot of different kind of parameters, and how we settle between all kind of derivative instruments and spots, and how we calculate fees as well. That is uphill battles to a lot of custodians at the moment. But we're going to work with our partners to tackle the challenge. Essentially, we will allow our users, at least a subset of the users, to have the token in a third party custodian. At the same time, they have the equity balance on an OKX.com.
Yeah, I would just say I think you're going to find that a lot of people are underestimating exactly the technical challenge of doing this. Not only doing it, but doing it well, because there's a lot of pressure on the exchanges right now. Because we know that if we don't get this right, and a lot of this tech, by the way, is a fairly new application of it, so it's going to take some time for the larger exchanges to get this right. Which is why I think you see a number of the exchanges like us who are kind of starting out with Bitcoin and are going to be, rolling up, additional sort of tokens as we move on. But the challenge in doing this, applying a Merkle tree, getting users their own Merkle leaf, it's going to take time to do right. But it is going to have to happen. And again, we are working towards it. It's just going to take time.
And adding to that, I think, there's people might think, okay, why are we in this situation? Why actually exchanges are holding clients' money? But and I've always, as a founder of a custodian, I've always been wondering about this and when actually it will happen that exchanges will have to move to independent custodians. But if we look at the industry, right, the way it evolved. Actually, the largest players have always been the exchanges. And when they started operating their businesses, there were actually no real independent custodians, right? So the exchanges have built probably the best custody platforms by themselves, right? And now they are quite attached to them, right? And they believe that they're kind of very well integrated in their business model, and it's quite hard for an exchange that has been operating their own custody platform for a number of years to start thinking about opening up to the outside world and outsourcing this risk to somebody else. But I think it's a natural evolution. Exchanges like your exchanges have already taken the first steps. Other exchanges will have to follow, otherwise they will lose market share. And I think we will see more and more of this pressure coming from, firstly, from audit companies. For example, yesterday I was on the phone with one of the big four, right, and on the fund audit side, and the auditor was asking me, so how do I make sure that the assets that this fund is holding on this exchange actually on the exchange? Right? And it's very hard, right? So introducing this concept of proof of reserves and proof of liabilities. But as soon as audit firms will start putting pressure on exchanges in order to get audits for their funds, then we'll see kind of the first steps towards this kind of outsourcing. And it will be necessary, Gregory, to answer your question, that exchanges are working together with custodians, because each other, we have to understand each other's business model better. In order to provide, at the end of the day, a very good client experience for the end client.
One thing I'd add here that I think I've seen a lot of discussion on crypto Twitter about why most of the large exchanges are using, well, none of them are using the big four, right? The Deloittes, the Boston Consulting Groups. The big four don't really understand how to audit our industry and don't feel comfortable doing it and putting their reputation on the line, which is why, we felt really good about getting Mazars, which is, a top 10 global auditing firm that has a team that they've been building over the last 3 years that specializes in auditing, crypto companies. It's a specialty that they're still frankly working on. And they've started to create some new ways to sort of verify ownership of funds because it is a huge challenge. One of the ways they do it is, they asked us to strategically move funds from one wallet to another for very specific amounts at specific times, which allows them to make sure that we have ownership over those wallets. And so there are some interesting new ways that they're looking to sort of verify. But again, it's still probably, at least today, third-party auditors are pretty far behind the curve. And I think that's why these other sort of technological, smart contract-driven fixes are probably going to be much more accurate and probably trustworthy for the user community in the short term. I mean, let's be fair here. Third-party audits traditionally have not been great. Enron, third-party audited. Lehman Brothers, third-party audited. Find me any single traditional financial institution that completely imploded. All of them had a financial auditor. So that alone is not going to save this space. And frankly, crypto and Web3 was built to be better than traditional finance. And I think that's why you're seeing a big push from industry leaders, like Vitalik, who are looking at things like the Merkle tree to push beyond those sort of traditional levers that, the Goldman Sachses of the world, pull, because even those are open to corruption. Again, code is incorruptible. It's just we're still working out that code and how it can be applied properly.
Yeah, I strongly agree. FTX is GAAP audited according to GAAP standard. So the industry cannot rely on old school way to enhance transparency. We need to achieve transparency through technology methodologies. Merkle tree proof of reserve. Even the next step would be adopting the knowledge proof in the UID level is the way to go.
Yeah, I think for except for auditing, there's another problem about independency, I think. So today we can see that centralized exchange platform, they're basically doing everything, including listing, trading, or custody, but or even investment. So this kind of thing in traditional financial world really doesn't make many sense. So I think for centralized exchange or centralized firm, the third party or independent custody service is pretty necessary. And actually at the same time, it don't have to be a real third party, but the centralized platform, they can always think about ways to make it more decentralized or transparent. For example, they can use NPC technology or other technology to make it less centralized and more trustworthy for the clients, especially for institutional clients.
Yeah, the custodian solution right now in terms of third party is already NPC, NPC technology. The problem is not in terms of independence. Exchange, do you want to be being independent? A lot more relies on third party independency in terms of replications. But the problem is they're not ready. A lot of them are not ready. Echo to Patrick, Big Four is so not ready. There are a lot of crypto funds want to be audited by Big Four auditors. In terms of how they in terms of client related statements, but they simply don't understand how we calculate, for example, a very simple thing, how we calculate unrealized margins, how calculate how to tokenize, how value the token. I think we did spend a lot of time for the last couple of years to educate Big Four about how a product works and how we settle. And they don't even have a concept of ADL, auto deleveraging. They don't understand. It's a very unique for them, for crypto industry. They need time to digest. I think it's a lot better this year. but we talked about proof of reserve custodian. That's another chance to them.
Gotcha. And so I think it's important to have that conversation about, what exactly custodians provide to both retail as well as institutional clients. And that I think, you go on crypto Twitter and someone's like, a custodian, you're just transferring the risk over to them. If the custodian goes under, you run into the exact same problem. And, when we think about custody, it would be great to hear from all of our participants here, like, what exactly does it mean to be a qualified custodian? Where is that trust? And a lot of people have been saying, not your keys, not your crypto. Would love to hear.
So I'll kick off. The custodian model is as old as finance is, as old as money is, and it's a pretty simple business model, particularly in crypto. If a user comes and buys a Bitcoin, we hold that Bitcoin until they come to sell that Bitcoin. And if somebody else comes and wants to buy a Bitcoin, we have to buy another Bitcoin. It's really simple, and holding those so that regardless of whether the price of Bitcoin goes to $1 million or $1, it shouldn't matter for a custodian because you always have that Bitcoin sitting there to be handed off. And I think following FTX, there has been maybe an overestimation as to exactly how many companies potentially aren't being good custodians. I mean, this is a very serious but also very simple concept to grasp. Again, though, because we've had a series of issues in the past, right? There's positives that come with the custodian sort of model too. When a user comes to Binance or they come to OKX or KuCoin or one of the other exchanges, Kraken, Coinbase, you get a certain benefit with that too. You get their platform, you get access to other sorts of investment tools and savings tools. And as long as those things are also risk averse, so that if somebody is taking out, for instance, on Binance, if someone takes out a margin account on Binance, they have to put up their own collateral in order to take out that margin, right? FTX was allowing them to take out a margin thing, and they were using other users' collateral, if the reporting is accurate, to back up those potentially bad bets that users were using. But that's a really rare thing. No other exchange that I know of or that we've seen seem to allow users to do that. Because again, you should always have this very simple one-for-one, proof of custody system that users always have access to. And as long as you do that, as long as you maintain that one Bitcoin for that user, as long as you aren't taking out a bunch of debt, as long as you aren't loaning out those coins to other platforms or users or engaging in really aggressive derivatives trading, it doesn't really matter what the price of Bitcoin does, what the price of Solana does, the price of BNB does. You should always maintain proper custody, and then your users can feel safe and have access to all those other tools that they get for being a part of your custodial platform. And so I think that is why we're probably still going to see CEXs. They're going to have this critical role because people want all those other benefits that come with going to a large platform. At some point, DEXs are probably going to evolve and they're going to have more offerings, but we're just not there yet. Someday, just not today.
Let me add on that, Patrick. So obviously, this would be the ideal situation that you have exchanges as kind of custodians and they hold one coin for one coin, right? But this is not really the reality for most platforms, right? If this was the case, then when you sign up for an exchange, there would be a simple custody agreement that would basically tell you that your assets will never be used for anything else. Funnily enough, FTX was one of the few exchanges that actually had this kind of more or less custody clause, right? That the assets couldn't be used for anything else. But for most of the other exchanges, people don't even know that when they deposit their funds on the exchange, they actually become unsecured creditors to the exchange. And this is a very important point because, going back really to basic financial audit, right? When you deposit your assets on an exchange and you are an unsecured credit, your assets become part, right, of the exchange's balance sheet. So which means that whatever happens, if something goes bad for the exchange and the exchange goes down, you are, as a depositor, in line with all the other creditors with your claim on the exchange's assets. If your assets are held in custody, then that means that your assets are never on the exchange's balance sheet, which means that you don't have to line up with the other creditors, but the exchange has to return your assets because they are just holding your assets in custody and they're not there. The ownership is not transferred to the exchange. So this is a kind of very big difference, and I mean, I urge everybody to go and kind of read the fine print of the most of the exchange's terms and conditions to see how they kind of how they basically write it and explain it to customers, and the fact that most exchanges can do more or less whatever they want with customers' assets. Now, if we really move to a segregated independent custodian, right? In a nutshell, what it means is that exactly what Patrick said. You give me a Bitcoin, I have to hold it, and obviously my responsibility is to hold it very safely. My responsibility is also to only use that asset according to the instructions that I receive from the client. So meaning that I cannot do anything else apart from what the client is telling me to do with that asset. But in the challenge, is I think what we're discussing also today here is, okay, the asset is there, but how can I make it available for whatever the client wants to do with other intermediaries? So you have the safekeeping, you have kind of receiving instructions, and you have the safely making the asset available for financial transactions in the financial market.
Well, yeah, as an individual myself, I totally agree with not your keynote you answered. But since I'm pretty familiar with this industry, I can really do that. But I think for institutions, it's not really realistic to ask them to manage the private key by themselves. And it's the same for some like Web2 users or potentially some potential user of crypto. So it's not realistic to ask them to do that. So on top of that, custody is still like necessary, and so far it's the best solutions for institutions. For example, for HashKey Capital, as a 1 billion funds, you cannot ask a certain person to manage the private key for all of our assets, and these assets are even not our own. It's from our LP or our clients. So it's still very hard or very early stage to go completely decentralized. So at this moment, I think the problem is how to make custody more trustful. So the first level, I think it would be regulation. So apparently, most assets will prefer, most clients or institutions will prefer the license, the custody service provider with license. Or the second level is the insurance. So if the custody service provider have enough insurance coverage, it will be also very helpful for them, for them and for their clients. And we can see that except for like third-party insurance coverage, many custody or many centralized platforms, they will have their own like safe, SAFU or some like funds, secure funds for their users. I think it could be a very good complementary for all this efforts done, and including technology level or insurance level. So this is the direction to maybe to develop or to discuss with the clients as well as the custody service provider.
It's true. Private key management, especially for large AUM, is very challenging. We've been building exchange for 5 years. We see it's a honeypot, what we call a honeypot issue. If everyone knows that in certain wallets, even a hard to wallet, you got a substantial amount of fund, you will be targeted. It's a true, very professional jobs. And we see a lot of professional players, including institutional, they think they have the capability to manage the private key, but actually it doesn't. And they will, and we see a lot of internal hacking cases within that case, within the institutional, within the organization itself. It's not exactly very easy job. So I highly recommend it. Institutional with not confidence enough to build their cybersecurity team, they should delegate to professionals. And yeah, to echo that second point, rather than ask custodian, third-party custodian or exchange a self-constitution capability to find a proper insurance company to immute to cover underwrite certain kind of risk. That's another topic that the industry, especially in insurance industry, need to have a really deep research and how to work on this. At this point of time, it's not that particularly ready.
Gotcha. So on that topic, I'm curious to hear, given all the events that have happened this year, how has institutional interest in both centralized exchanges on the trading front as well as within, custody, how has that looked more recently? Have we seen more institutional market participants, wanting to adopt something like a custodian, or are we seeing, kind of a pullback in general interest?
So a lot of yeah, sorry, yeah. Day to day, we are head of institutional here. So, quickly is they're all looking for different kind of alternatives, for decreasing the exposure on exchange or counterparty as well. That's a general mandate, general concern. On the one hand, they demand exchange, or even their counterparty like prime brokers to enhance their even the transparency or the capital. And they're looking for alternatives like a custodian solution everywhere as well. So in this sense, yes, the industry is panic, and they demand a lot more transparency, and they want to de-risk. They don't want to de-risk from a lot of counterparty. That's industry mandate right now.
We're seeing the same thing. Institutional investors are getting more excited about the industry, and that lasts to a certain extent because they're looking at a marketplace that is a good time to buy into. I think they are absolutely looking to de-risk their engagement with the industry, and they'll be continuing to put pressure on the large exchanges. Because again, large exchanges have true value for these companies, and the reason is liquidity. If you want to do large trades, you want to have efficient matching. You have a buyer for a seller. You have to have access to large liquidity pools, and the only way to really ensure that efficiently is through a CEX today. And so, even though, they're going to continue, just like our normal rank and file users are, to push for more and more transparency to de-risk their portfolio as they enter into the crypto space more. We definitely don't see them thinking about investing in this industry less. They're looking to get into it in a larger way. They just want to figure out what's the best way they can utilize their leverage to get us to sort of be more transparent, give them more assurances, which I think is fair game. That's what a free market system is. And that's why we're doing things like going through and doing proof of reserves and liabilities and everything else.
Well, I think maybe Alessio, maybe the better person to answer that, but I would like to add some words here. So, well, from the perspective of HashKey Capital, well, we are also an institution. At this moment, we actually need custody even more than before. So, well, most of our capital are still in closed wallets or in third-party custody. But for traditional institutions, well, I think it might be the same. Well, many of our LPs are from traditional finance. They're still interested to crypto sector, but well, they become somehow more cautious than before. But what we get is that they would pay more attention on how the GP manage assets. And some of the LP even make requirements to put assets in third-party custodian. So I think on custody side, things won't change too much, or maybe it's a benefit for custody services provided.
Yes, thanks. Well, I mean, since we are mainly 99% a kind of custody-focused company, we've seen large inflows in terms of new clients, starting from, I would say, I mean, it started kind of in the second half of the year after the failure of a number of platforms, but obviously it accelerated in November after the FTX event. So we've seen more and more clients asking and opening accounts in terms of custody. We've seen more assets coming in from clients that probably had clients that were already our clients, but probably had part of their assets on exchange and moving the assets out from the exchange in custody with us. We've seen more OTC activities. So people that clients that basically want to trade their assets, but do not want to transfer them back to the exchange, but prefer to kind of use an OTC service that minimizes the kind of settlement risk. And we've seen more pressure in terms of settlement cycle. So clients that really want to settle in T+0 or doing kind of fractions of transactions to minimize kind of the exposure to any kind of parties. Funnily enough, we've also seen some kind of inflows in terms of fiat custody, the US dollar custody. Clients that at a certain point in time, I guess a few weeks ago, did not trust the main banks that offer fiat services in the US, and they were moving kind of fiat assets to independent custodians. And probably the one that we haven't seen yet, but I'm still positive about it. We haven't seen exchanges actually coming to us and asking on how we can kind of work in the long term to develop a solution that would be kind of more palatable for their clients.
Gotcha. So, shifting gears a little bit, how should digital asset firms, engage with regulators in the short and long term?
Maybe let me start with this one. From our side, the conversation has always been the same. So when we go and talk to the regulators, we want to really try to make the regulators understand the importance of independent custodians here in the blockchain space. And I would say that most regulators are receptive to that, and I think even more after what happened in the last few months. In fact, we are in the process of one license application, and I think the speed at which the regulator was processing the application increased after what happened. On the other side, there are regulators that they're taking kind of a little bit of a strange stance. And I mean, since Xiao Xiao is here, I'm also interested to know that her opinion on, for example, I'm based here in Hong Kong, right? And we have a new regulation coming to being on the table for discussion. And funnily enough, this new regulation is for digital asset exchanges. But the main point of the regulation is that there's not going to be any regulatory licensing for custodians, but the only licensed entities that can do custody of clients' assets are actually exchanges. So the regulation here in Hong Kong is that basically exchanges will have to become the custodian of the client's assets, and there's not going to be any other possibility for the licensees in this jurisdiction. But this, I think, is a very strange case of how a regulator interpreted the market. I'm happy to hear Xiao Xiao's opinion on this.
Yeah. I think for our regulation framework, it definitely makes sense to have an independent license for custody service provider. I mean, it's just like banks in crypto sector, right? So it's like the fundamental of all this crypto-related business. So it's quite important to make it independent. And also, I think for digital asset firms, it's kind of like a mission to communicate or even educate the regulators. So I think the following, maybe in short term, there are a lot of like conversation between digital asset firms and regulators. Well, in Asia, HashKey is doing that. I think Hex Trust is also doing that. And because well, we're deep in this industry and know exactly what's the best practice, like how blockchain can help increasing the transparency, how to mitigate the risk of like mixing users' assets with operation assets. So especially the blockchain technology part, I think in the near future, the regulators will know the importance of leveraging blockchain technology, like put certain process on chain, or maybe have on chain proof or on-chain auditing or something like this. All this like on-chain stuff will be included to regulation framework.
As at Binance, I think what we're trying to talk to regulators about most right now is how they can sort of pivot in what their prioritization is today. I think anytime you're going to regulate a new asset class, particularly something like crypto, that in many ways is just so fundamentally different in how you think about traditional fiat, traditional securities, traditional commodities, there's a tendency to want to take that asset class and make it fit into the pre-existing parameters of how you regulate, other sort of existing securities and other existing commodities. And it's proven that that's really challenging to do. And so what we've seen is a lot of regulators are trying to regulate via enforcement, right? What are the enforceable sort of rules in place that we can hold them to that are pre-existing that we can use to sort of bring this industry, into greater compliance to a certain extent? And so that's why, we see things like a lot of actions taken around KYC, AML, sanctions in the US, which are really important, by the way. But I think the reality is no user anywhere has ever really faced any sort of like financial harm from a company not having a stringent enough, KYC process in place, right? The things that really impact users are things like proof of custody, proof of reserve, and having strict rules around that. We actually agree. A separate license for custody makes total sense. Like there should be very clear rules around what it means to hold these assets in custody. And that should be like number one. Number two, how do we measure risk around these asset classes? And then number three, how are we communicating risk to users? I think for us, those are kind of the three most important aspects of regulatory policy that today can make a real significant difference in protecting users across the globe. And so, that's what we're really talking about most right now with regulators. We have been talking about that for like the last year. And I think FTX was without a doubt a huge black eye on the industry. I think it's somewhat unfair. We'll see what happens as the investigations kind of roll out. But I think this was truly a black swan event. And I would never say there's a silver lining to this, because a million people being robbed of $8 billion that's not in the greater good. It never will be. But I think we will start to see a speeding up of regulatory policy as a result. And I think they will be more inclined to look at some of these measures that are truly user-focused first, before they kind of focus on the other issues, which frankly, there are some technological challenges when it comes to permissionless networks and some of those traditional financial sort of rules and regulations. And so that's really what we're talking about. And we're really pushing most other companies in the industry to push for the same kind of user-focused initiatives.
Our conversations with regulators, especially after FCX saga, is I think they would put a lot more attention of how exchange manage current assets. A lot of them is asking whether or not independent custodian should be included in one of the licensing prerequisites. And also, they're also exploring alternatives that custodian is a separated. I mean, crypto custodian should be a separated regulatory regime. assigned for the exchange license. So what we're seeing that in industry so far, like regulators so far, is we're going to expect at least a separated regime or framework just for crypto custodian, and whoever want to be the crypto operators might necessarily need to be either one of them, or be need to apply for capability for regulator for licensing conditions with the capability to similar with managed client access as in the form of custodian. So we are seeing these two things happening in the latest regulatory requirement developments.
So I guess a follow-up to that would be, there's a big narrative on crypto Twitter about how regulation as it currently stands pushed a lot of users towards FTX. Do you think that's necessarily true? What are your general thoughts there?
So what's the question? Sorry.
So, do you think regulation as it currently stands, with particularly around access, within the U.S. to derivative products, do you think that regulation pushed users to using a platform like FTX, for example? And should regulators take that in mind when thinking about how that affects user behavior and user decisions?
Well, in what way would it drive users to FTX? Can you go a click deeper for us on that?
Yeah, for sure. So I think there was a thread a while back that essentially said that being able to access digital asset derivative products within the U.S. was incredibly difficult, and so a lot of people were using FTX accounts that they may have been able to slide into without proper KYC, and then money gets locked on the account. And people were saying, okay, if U.S. regulators were able to be more friendly with derivative products within the U.S., there would be more options for U.S. market participants to go through regulated means and essentially have more optionality to engage with the market in manners in which they would like to.
I think that's tough. Listen, users are always going to look for more options. And if they can't find those options in their own backyard, they're always going to look externally. I think, to be fair to regulators, and I want to be fair to them, I think derivative products, particularly in the US, have a little bit of a taint to them. And when you're talking about derivatives in the crypto market, because of the level of volatility, is truly a feast or famine kind of scenario. And I think before US regulators could even think about regulating derivatives, they probably needed to figure out just the basics first, like how they're going to regulate the spot markets. And so, listen, I think that there's a lot of reasons we could point to people in power and blame them for FTX. I think a lot more people were drawn to FTX because Sam was able to build this sort of cult of personality around him with policymakers and politicians and media and some of the most respected sort of people in power across the industry. I think that probably was a much bigger draw for people to FTX than just being allowed derivatives products. So, we obviously believe that derivatives is going to be a key sort of product that every single user should have access to. I think it's just hard to place blame at the regulators' feet in this specific scenario.
Yeah, completely agree with Patrick. So for derivatives, is always very high risky products, even for traditional financial assets. And for crypto, the risk is I would say is even higher. So it really makes sense for the regulators to put some limits on the retailing derivatives trading. So we cannot blame the regulators on this. But I think there's one thing missing in this maybe communication is that the public or the retailing user needs more education on regulations. they need to understand why the regulator ban certain things, or ban certain like business in certain area. So this is one thing. So maybe for retailing users, they also need to do their own research, like what's the risk behind maybe FTX or a certain centralized exchange, and what's the relation between this platform to other like entities, for example, the relation between Alameda and FTX exchange. So they need to do some basic research, and then they will decide whether to participate in this speculation or this high risk, even higher risk um, tradings. So this is my thought.
I think it's so hard because the crypto derivative products is very different than CME futures product. Very, very different. We call it unique product. There's a unique product called in crypto called perpetual swap. That's not happening in TradFi. That's a very unique mechanism. That's how we manage clearing counterparty risk in crypto. We call it clawback and or auto deleveraging with insurance fund. That's not happened. That's currently not happened in CME as well, framework as well. There's a very unique product called you can deposit. You can basically use token as a margin to trade on that particular underlying, like Bitcoin margin futures or perpetual swaps. That's also not happened. It's not available in TradFi in CME framework at the moment. So if you really want to move crypto derivatives in US, they need a lot of innovations on their infrastructures. And if they want to allow a private company like maybe probably Coinbase to have to offer crypto derivatives, I think that's another innovations of the security and regulated framework and infrastructure as well. I think it's hard, very difficult. And echo to Patrick's, they don't even understand how to regulate spot at the moment.
Yeah, and I mean, just to add from my perspective, I used to work for the regulator early in my career. I think, yeah, everybody always blames the regulator, but I mean, we also have to kind of cap their liability and responsibility at a certain point in time. So there's always a trade-off between protecting consumers, clients, etc., and at the same time maintaining financial stability of the market that they're kind of have supervision on. In this case, I think the role is to make sure that there are viable options in the market that they supervise, and to make sure that these options are at least competitive with other markets, right? Then at a certain point in time, it's never going to be possible for regulators to completely ban clients to go outside and find other offshore options for their own entertainment, right? And I mean, the role of the regulator is to make sure that solid options are available in the market, and then at a certain point in time, if clients want to really go and look for other options outside, I guess this is really outside of the responsibility of the regulator. In the case of derivatives, I see a little bit of responsibility here for regulators. Because I mean, this product has been around for what, Lennox, probably 5 years, 6 years now, perpetual swaps, and it's a very well understood product. More or less every major exchange offers it. So I think it's really time for regulators to understand this product and put rules around it.
Nice. That was good to hear.
Yeah.
Gotcha. So with 5 minutes left, we can open it up to questions in the chat. We've got one from Sasha, which is, would licensing kill the idea of decentralization?
I'll take this one at least from a custody perspective. Yeah. So I think licensing doesn't really impact kind of the decentralization in the custody piece, because fortunately the blockchain technology always offers clients the option to actually self-custody their assets. But again, going back to the concept of custody doesn't mean that your assets are not decentralized. You can do your kind of self-custody. Using a custodian basically just means that I want to own my assets, but I don't want to have the responsibility to protect my private key. So I'm appointing somebody else to do it on my behalf, right? And I really don't see how this kind of concept of outsourcing your own security can actually kill the concept of decentralization. So at least from the custody perspective, I don't think that there should be, if thought and framed in the right way, I don't see how that could have an impact on decentralization.
I'm gonna take a wild stab and guess that Sasha is talking about licensing of custody and whether KYC would be required of licensing. In which case, I think that's a question that the community has obviously been debating for some time. Eric Voorhees and Sam Bankman-Fried had a pretty infamous discussion about this and whether you can have true decentralization while requiring KYC. I think it's a really interesting discussion to be had. I think obviously we do believe that a decentralized market system is where this is going, and it'll probably be some form of true peer decentralization at some point in time. I think right now regulators being able to wrap their heads around the idea of not having users on a platform that are KYC'd, I think that's probably not a reality in the short term. Possibly in the mid to long term too. I just don't know. So I think, I don't know, Alessia, if it was phrased like that, as someone who works in independent custody, what would be your opinion then?
I mean, one thing is to be anonymous. A different thing is to be decentralized, I think, right? And I mean, now we have ways, and technology is allowing us to have ways in zero knowledge, etc., in which, I mean, your identity can be with somebody, but not with everybody, right? So in an ideal world, you have one licensed entity that you trust to your identity, and then the other intermediaries in the market allow you to trade with them or transact with them, and you don't need to reveal your identity because your identity is already revealed to a licensed entity. I think, obviously there's a lot of steps that have to be built to get to that level, but I don't think we're heading towards a world of anonymous transactions anymore. I think the kind of KYC and AML and it's probably a non-negotiable item for all the regulators around the world.
I think licensing and decentralization is can exist at the same time. There's nothing in conflict. So licensing just means the activity or the business is under the monitor of regulator, and the entity or the firm has the liability to make report to the regulator or make report to the public, and the content of the report can be something like on-chain or open data. So those two things can exist at the same time.
Yeah, final add is it won't. The licensing always slow. The licensing in majority is they would have a licensing requirement related to how a user can potentially access the world of decentralizations. So what will most likely to happen is we're going to have a really robust decentralized marketplace with ample liquidity. For example, like DeFi Pool, DEX, or NFT marketplace that's situated in all kind of layer one chain. But it still needs a licensing entity, either an exchange or custodian, to grant an access as in a form of KYC or regulated manner for them to access.
Gotcha. And final question from Sia is, will exchanges also take a dive into custody service and provide it as an option to customers?
Well, I'll start. Yes, I mean, Binance already has 2 different custody offerings, and whether we'll continue to make that a core offering or not, I think it really depends. Obviously, Alessio has a complete independent, custody offering, and there's value for users potentially having, that third option, and there's probably value for us in also providing them that option to de-risk them, our users, from being completely encompassed in the Binance ecosystem, because some users probably don't want that. I think you're going to see that CEXs are going to continue to pursue and grow into the custody space, but I don't think that means that the entire industry is going to, move away from independent custody. I think if anything, we'll probably see more independent custody options, falling into favorability with users. And I think that's fine. It's a sign of a healthy system. We should have diversity of products.
On OKX side, we probably want to be a more open platform to allow more custodians to provide their unique offering. So we introduce clients, allow clients to have an options to pick their very own custodian, calling a different kind of capability. We probably want to become an open platform for custodian to onboard. Our job is to make sure custodians understand each other's and integrate seamlessly on a technical level.
Yeah, I think for exchange platform, they may become something like a aggregator for custodian. So it's like they can do like cross custodian platform settlement, something like this, and they can also offer their own custodian solutions. Yeah, I think this is the trend.
Gotcha. Well, that's all the time we have. I'd like to thank our guests for joining us. Definitely a great discussion, and everyone has a good rest of their evening or morning.
Thanks, everybody.
Right.
Thanks, folks.
Everybody.